Hi, today we're going to talk about the subject of Chapter 4, which is preparing the financial statements from the unadjusted trial balance and closing the books. Here we see from the PowerPoint the adjusted trial balance for Smart Touch. We discussed this before. We have all the balance sheet accounts on the top, all the income statement accounts on the bottom. The income statement amounts come directly from the section on the income statement. Notice revenue is at the top, all the expenses are down below. Net income is $8,550. For the statement of owner's equity, we get the information from two places. In the first place, we get net income from the income statement. So that goes directly under beginning capital. And then we get beginning capital and withdrawals from the balance sheet. Again, the format for the statement of owner's equity is beginning capital plus owner's contribution plus net income, sum that up, then subtract withdrawals, and that'll give us capital at the end of the month. For the balance sheet, we need information from a couple of places also. We get the capital amount from the statement of owner's equity. So again, there's a link between the income statement and the balance sheet and the statement of owner's equity. Income goes into the statement of owner's equity. Ending capital from the statement of owner's equity goes into the balance sheet. We also can prepare what's called a classified balance sheet, where we list the assets and liabilities by their liquidity. Liquidity is a concept that basically says how quickly can you convert the asset into cash. From the liability standpoint, how quickly must the liability be paid off. So cash is obviously, if you look at the balance sheet, the asset side, cash is obviously the most liquid asset, followed by accounts receivable, office supplies, prepaid rent, etc. And then we put the long-term assets down below. In the same way, we put current liabilities on the top of the liability section, and then long-term debt and equity at the bottom. This PowerPoint explains that in these two slides. And we'll talk about this a little bit more in Chapter 5. The worksheet that we've used before can also be used to very easily prepare the financial statements. The bottom section is our income statement. Top section is our balance sheet. I'm not going to emphasize the worksheet. Once we have the adjusted trial balance, it should be fairly easy for you to prepare the financial statements. Key element in Chapter 4 is closing the books. If you think about it, our income statement related accounts need to be closed. Why? Well, let's say you had $50,000 revenue of the previous year. If we didn't zero that out at the end of the year, we'd be starting the next year with $50,000 in revenue. Same with expenses. Then the only other non-income statement account that we have to close are the withdrawals by the owners. For example, if the owners withdrew $50,000, we don't want to start the next year with that same $50,000 because we want to measure withdrawals over a 1-year period. This diagram is the key to the closing process. Basically, there are 4 steps. First, we zero out all of our revenue accounts by debiting them, and we credit this temporary account called the income summary. The income summary is an account that is only used to hold temporarily the revenues and expenses. At the end, it is zeroed out and the balance is transferred to capital. So we close revenues to the income summary. We close expenses by crediting them and debiting them to the income summary. Notice, just like revenues and expenses, in the income summary, revenues are credits and expenses are debits. The difference between the two, the ending balance, is our net income, and that's what we transfer to the capital account. So step 3 is to close the income summary and credit capital for the amount of net income. The very last step is to close the withdrawals account. By crediting it, we debit the capital account. So although revenues and expenses are closed to the income summary as an intermediate step, and only then closed to capital, the withdrawals are closed directly to capital. And it should make sense. Anything that makes net income big is going to make equity or capital bigger. And if owners take out more money, it's going to make capital smaller. So study this diagram both here and in the book, because it's the key to what's in chapter 4. Here's an example. Our service revenue at the end of the year from our trial balance was $17,500. In order to close that to the income summary, we debit revenue and we credit the income summary for $17,005. Now the income summary has a balance of $17,005. Here are all our expenses. Notice we've credited all the expenses, we've gotten rid of them, and we've debited the income summary for the full amount. And now our income summary has a balance of $8,550, which is equal to net income. Our third step is to close the income summary. So we credited $850. We debit it by $8,550, and we credit capital $8,550. This closes the income summary. And finally, we close the withdrawal account. In this case, we're going to debit capital for $5,000 and credit the withdrawal account to close it out, leaving it with a balance of 0. And now our capital account should have the proper balance, which in this case is $51,550. For our purposes, we won't really worry about the post-closing trial balance. It should be obvious that what's happened with the post-closing trial balance is it's simply the adjusted trial balance with the withdrawals, revenues, and expenses account zeroed out and capital updated to its final result, which in this case is $51,550. This slide is very important. This summarizes what we've learned in chapters 1 through 4. Remember, in chapter 1 we started with the beginning of the accounting balances. We learned how to analyze and journalize transactions, so we're doing the journal entries there. We post the journal entries to the ledger. We prepare the unadjusted trial balance. And if you will, you put those amounts into a worksheet. Then you journalize and post the adjusting entries. And only then, in chapter 3, do you prepare the adjusted trial balance. And finally, you can prepare the financial statements, journalize and post the closing entries, prepare the post-closing trial balance, and then the cycle begins again. This is what we've done in chapters 1 through 4, and this is going to be fundamental for the rest of the course.